to middle. Okay. Welcome to another Friday Lunch and Learn. Hey, Kim. I know you've been quiet, but still, anyway, welcome. Today, I thought it'd be cool or a little important to talk about the two addendums, the seller financing and the loan assumption addendum, because as the market shifts, right, interest rates are still up, right? You still have people that would need to buy, but it's expensive. If you assume a loan that's a 2.99, well, that's a pretty good deal, right? You over 30 years, you're saving a ton of money. Or a seller may have a property free and clear. They don't want to rent anymore. They want to sell it, but they don't want to get hit with all the capital gains or all the funds at once. They may have an opportunity to make interest over time being the lender. And so we've seen more of this. When the market shifts, you see more of this come up. Second notes, first notes, seller financing, and so forth. And a lot of agents go, what do I do? Because, it's risky, right? Because you're dealing with financial terms and math. So I want to cover kind of the best practices and the forms themselves. And before I even share the screen, take your mate. I just want to say that all we're doing when we do this is taking direction from both parties, and we're agreeing upon the terms. The actual paperwork for an assumption or a seller financing is done by professionals, either an attorney or a mortgage person or someone else is handling that. But what you're doing is between buyer and seller is going, well, what's the interest rate? How many years? Is it interest only? Is it not? And making the choices there. So we don't get in trouble as we fill in the form, but really we're just establishing the framework for it. And then we're not actually creating the documents for it, which is really keen and cool. So I'm going to go to share my screen. All right. All right, Kim, give me a thumbs up. You see it? All right, cool. As I said, there's two forms, the Shrek form 26-8 and 41-3. So the first thing is the seller financing. And really just think about this. When is seller financing a good option? Well, typically when the owner owns a property free and clear and they don't need all the proceeds right at once, or maybe there was an investment property where they didn't live in it for more than 2 years in the last 5, right? Where they have a capital gains penalty if they sell it. So they go, well, why don't I take a small portion of it each year over a period of time and, take a smaller tax hit, if you will. When does it make sense for a buyer? Well, a buyer may not qualify for additional mortgage. They may have to put less down, or maybe they have a job that they can't prove enough income for a short period of time, but they're going into full time. There's a lot of reasons why this may make sense if you have the right buyer and the right seller. We still get paid. That's a key too. A lot of times when these seller financing things, you want to make sure that the buyer puts enough down to make sure that the agents get paid at closing, right? Because otherwise you may be waiting to get your paycheck later on with these things. So it's something to think about when you're doing seller financing. Okay. And what's a risk to a seller? Well, clearly, typically you want to make sure that the buyer is qualified. What if the buyer doesn't make the payments, right? Well, you're now the lender, as the seller, you've got to foreclose upon the buyer, and they may destroy the property. There may be issues take time and legal costs to actually foreclose upon, and then have to fix it back up and resell it again. So there are risks. You want to make sure you have a serious buyer. And what's risk to the buyer? Sometimes a buyer can get into these situations again with the lender, and something could happen to the lender. They could pass away. Then who's handling the note? The buyer could pay the down payment and they could pay the month on time, and then maybe they can't. Right? The foreclosure process is different with a seller versus a bank, and there may not be a cash for keys. So there's definitely pros and cons for both. So can any seller offer seller financing? And the answer is yes, but typically it's only ones that actually have it owned free and clear. If they have a mortgage, we're dealing with a wrap type of thing where they're financing part of it in a second position to the major lien holder. So typically just the ones that own it free and clear. And so what do you think a seller would want in order to agree to a seller financing? Well, they're going to want someone that's got the income. You want someone that has a fairly decent credit score, right? And it may be someone that you're trying to help out, but you still want it to be the buyers to be able to make the payments, right? Because you're going to be the bank lender holding this note You may have some benefits coming your way, but you want this buyer to, to perform on the payments. And of course, I mentioned here, we're not the lender, so we can't prepare the loan paperwork. But what we do is we prepare these two documents that establish the terms of the agreement between two parties. And of course, I mentioned this only for reference. There's two different types of seller financing. The one we're talking about today is where the seller is the lender. They basically transfer title into the buyer's name, and they have a lien on the property as the lender, just like any other mortgage lender would be, where the buyer pays to the seller mortgage payments, either interest only or petty payments, principal, interest, and so forth. And, and it goes towards amortizing the loan. The other one, which you see a lot, especially on land, is installment contracts, like lease purchases, where you would negotiate a price, buyer would still make payments, but title isn't transferred until the buyer pays the property off. So sometimes that's called a lease purchase or a land sales contract. We're not talking about that today, but that's another option for a seller to sell to a buyer. Because in that case, it's much easier for the seller to foreclose because they hold the title, if that makes sense. So it's a little safer, but a buyer doesn't have the rights, the bundle of rights to do with home ownership in that case. They're basically tenants that have all the responsibility, but none of the benefits yet until they close. So something to think about. So the form itself, the Form 26-8 Seller Financing Addendum, I just want to highlight a couple things. Both forms, the assumption form and the seller financing form, start off the exact same way. So we talked about, what does the seller want, right? They're agreeing to allow the buyer to become the seller to become the lender and the seller, and the buyer to become the borrower and the purchaser. And so they're both going to want credit, and they're going to want to basically approve the buyer's financial condition, if that makes sense. So the big highlighted part at the very beginning is a disclosure to both buyer and seller. It says agreements for seller financing can be complicated and may be subject to laws regulating loans. That's why we can't do the loan ourselves. Consult an attorney and a financial professional before signing. Seller may have accounting or reporting obligations concerning the seller financing. Once again, interest they collect on the loan could be reportable. Certain types of loans are governed under the state of Texas. TREC rules prohibit real estate brokers and agents from giving legal advice. So read this addendum carefully. Okay. The very first section, I cut it up in 3 sections, is the credit, right? We basically want to say, all right, buyer, if you want us to basically finance this deal for you, we want you to provide your credit worthiness. So paragraph A is to establish the buyer's credit worthiness. Buyer shall deliver to the seller within so many days after the effective date of the contract a credit report, verification of employment, including salary, verification of funds on deposit, like a bank financial statement, and whatever else the seller would want. And this is buyer hereby authorizes any credit reporting agency to furnish copies of the buyer's credit reports to the seller at buyer's sole expense. Great. But in today's day, with so much fraud going on, you don't want the buyer to supply the stuff to you. You want their income docs, but you want them to go through a third party, sort of like a My Smart Move or something else, where the documents are being sent to you directly. The credit report's being sent to you as the agent or the seller. You're verifying specifically with the employer that they actually have a job. Those are the type of things, because a lot of things are being falsified now. So just be aware of that. And you may add that in there. You may want something else. And then buyer's credit approval. If the credit documentation described in paragraph A is not delivered within the specified time, seller may terminate this contract by notice to the buyer given at any time before all of the required documentation is furnished, and the earnest money will be paid to the seller. So right here, if the buyer is supposed to give all these credit documentations is, say, 7 days, and on day 8, if they haven't yet, the seller can terminate and keep the earnest money. So that is one benefit to the seller, but be aware as buyers, if you've committed to this contract on the buyer's agent side, they've got to deliver this stuff. They don't, that's a big risk for the buyer to lose their earnest money at that point in time. Now, if the credit documentation is delivered on time and seller determines in seller's sole discretion, because they're the bank, they're not, they can be subjective in this, that the buyer's credit is unacceptable, Seller may terminate the contract by notice to the buyer within 7 days after the expiration of time for delivery or its actual delivery. So once they get it, or 7 days after it was due, whichever is later, and then they say, you know what, we deny your credit, then the buyer gets to earn his money back and the deal terminates. So you have two things there. If the buyer actually supplies the information, the seller has 7 days to make a decision. And when they say no, deal's terminated, buyer keeps earns money. But if the buyer fails to perform, doesn't deliver them in time, then they put their earnest money at risk. It's a big thing. But this is all to qualify the buyer, like if they were applying for a loan, which they are, to the seller. Next part comes, okay, if now the credit has been dealt with, they've said, all right, we've supplied this stuff, seller is okay to approve the loan. The next step is logically, how do you establish the loan? There's two parts. There's the promissory note and the deed of trust. The promissory note is the promise to pay. It's the terms of the agreement. How much is the buyer going to pay over time? How much are they borrowing? What's the interest rate? When do they pay? What are the terms of the loan? And they're promised to pay according to those terms. The deed is what's recorded to give them ownership, right? That ties to it's the promissory note is tied to the deed, which is the ownership vehicle that spelled out these things as well. So you need both of them in conjunction, and both of those are prepared by title or an attorney or whatever. But what we're doing is establishing the terms of both right here. So, and there's lots of choices. So the first thing is the promissory note in the amount of blank included in paragraph 3B of the contract, payable by buyer to the order of the seller, will bear interest at a rate of, okay. So that's when you negotiate. What's rate? You know, the going rate for mortgage is now 6.5%, 7%, right? Or even higher. Let's say that the seller wants to do it for 6 or make it attractive, or 5 or 10 for whatever. Buyer may prepay the note in whole or in part at any time without penalty. So no prepayment penalties. So they can pay it off in a year, 2 years. They can refinance it, whatever it may be, when their credit is better. Any prepayments are to be applied to the payment of the installments of principal last maturing, and interest will immediately cease on the prepaid principal. The note will contain a provision for payment of late fee of 5% of any installment payment not paid within 10 days of a due date. So it includes a automatically generated 5% penalty for being more than 10 days late. Matured unpaid amounts will bear interest at a rate of 18% per annum per year, or at the highest lawful rate, whichever is less. The note will be payable as follows. Okay, maybe let them in. So they're setting the standard terms here, saying there's a late penalty for paying late. It's no prepayment penalty. The buyer can pay at any point in time. But if the buyer is in default, basically, then the rate jacks up to 18% or whatever the highest allowable rate is, a lower of the two. Then you have a choice. This is the cadence of how the loan's going to be between the seller and the buyer. Is it one balloon payment after so many years? So you want to say, I want to pay the entire amount with interest, at the end of the loan, monthly or quarterly, right? We're gonna pay this all at once. Number two, we're going to do this in monthly installments, including interest or plus interest, beginning on such and such date, and then going for how many months. And typically, you'll do something like this. You'll find a mortgage calculator you want to do at 8%, whatever it may be, over 30 years. And that's kind of your general thing. You may have a balloon payment in 60 months. That's where you're negotiating between buyer and seller, and I can help you walk through that. Or 3, which happens a lot for investors. It says interest only monthly installments for the first so many months. And then installments of what? Including interest, plus interest. You have choices here. So do you want to do an interest-only loan? So the investor oftentimes will do a 2-year interest-only, sort of amortized over 30. So the payments divided over 30, but the first 2 years they'll do interest-only, no principal. So the principal stays the same, and then in 2 years, typically they'll pay the whole thing off, or they'll sell the property or whatever it may be. And sometimes you'll see that. And so you have to figure out what interest-only is for that first 2 years, even though the entire thing is 30 with a balloon in 5 years or 2 years or whatever it may be. This is where that math comes in, but all you're doing is what the seller and buyer want. Typically, the seller wants to keep a loan, but they don't want to keep it for 30 years. They may amortize it over 30, but they want some type of point where they get paid the whole amount. And a buyer probably doesn't want to be in the situation for that period of time either. So you're probably looking at 3 to 5 years generally, sometimes up to 10 before it's converted, refinanced, or whatever. Now, then you have, now that you've established that we're going to get interest only, or we're going to get interest principal and interest payments or not, we're going to tie it to the instrument. It's going to be recorded at title with the note about ownership. Now we're going to transfer this property with a deed of trust, right? The deed of trust securing the note, the promissory note, which we just talked about. It says, couple questions here. The first section, paragraph D there, paragraph 1 says property transfers. It's either or. So does the buyer, that says consent not required. Property may be sold, conveyed, or leased without the consent of the seller, provided any subsequent buyer assumes the note. So can the buyer sell the property while they're in this seller financing condition to another buyer, and do they need the seller's consent to do so? Paragraph A says no, don't need consent as long as the buyer assumes the whole note and the seller continues to get paid as a lender. We're good. Spelling mistake? Okay. Anyway, and then the option 2 is consent required. If all or part of the property is sold, conveyed, leased for a period longer than 3 years, leased with an option to purchase, or otherwise sold, including contract for deed without seller's prior written consent, which consent that may be withheld in seller's sole discretion, seller may declare the balance of the note to be immediately due and payable. So this one, if you check option B on the seller side, the seller is saying that if you lease the property for more than 3 years, if you sell the property, you sell it on contract, whatever you do with the property, you have to get my permission first, which I can deny and ties it up. So typically you're going to see the paragraph 1 there checked, no consent. But if you're a seller that's concerned about this buyer's ability to pay, you may want to check paragraph B to allow them to get consent from you before they enter in a deal. And I've seen this before where a property gets multiple liens on it and where there's not enough to pay the existing lien. That's a risk a seller may look at when they're choosing these two and negotiating. And of course, then you go into paragraph 2, which says more choices. It said, well, all right, paragraph 2 says the deed of trust will provide that the buyer shall or shall not obtain basically homeowner's insurance. Well, yes, they should, right? Shall. Seller as the mortgagee, loss payee. So they want to make sure that the seller is on the insurance policy, that they're paid off in case it burns down, it gets flooded, whatever, right? So you want the buyer to provide housing insurance, home insurance that covers the mortgager, the seller as well. Then you go into 3 and said, all right, now we have options. We have to check 1, A, B, or A or B, and there's more options. So A says escrow not required. Buyer shall furnish seller before each year's ad valorem taxes become delinquent, evidence that all taxes are paid. So basically, A is buyer's only paying in principal and interest to the seller. Buyer's responsible by themselves to pay the taxes on the property. Okay. And then B is escrow required. So escrow required means they're collecting within the payments into a third party monthly, like a normal mortgage would, to pay for those taxes and insurance so that the seller is insured. And most of the times you're going to see B checked for that very reason, because you don't want the property to be lost in foreclosure or tax lien because the buyer isn't paying the taxes. So oftentimes you want escrow, a third-party escrow, to collect those within the payment so that when they come due twice a year, that they are actually paid on your behalf. If you check B, though, there's additional choices. Down at the bottom here, it's a little harder to see, but it says the escrow account will or will not be serviced by a third-party provider. So the seller could actually have their own account separately for this, but you always want a third-party provider. It's a small fee. You can split it or pay for it. And then there's a choice there at the very bottom. It says, well, who's going to pay for it? So do you want a third-party escrow to handle the payments? I'd say yes. And then you want to split it between the seller and buyer, or seller pay for whoever it is. It benefits the seller and lender to have a third party manage all the payments so that they can have this document at tax time of what's been paid, what's not been paid. And then number 4, prior liens, any default under any lien superior to this lien. So if they had, this was a second lien or whatever, securing note will be in default under the deed. So if one of the liens against the property defaults, they're all in default, and it triggers a foreclosure, if you will. All right. So on seller financing, the pros, seller can spread out their tax burden over many years. Okay. Seller can make the interest in addition to principal amount. So they can say, I'll sell it for 500, but they end up making 550 because they've made interest on it over time. Seller can often get a better or higher, cleaner offer. So if a buyer may want to pay more to have the ability for the seller to finance, plus the interest they make on the loan, and they may not have to fix anything because the buyer is assuming the property and wants to live in it. So oftentimes it may be a stronger offer, and they may make more money over time. And once again, make sure that you get enough down payment to make sure you get paid as your commission. Pros, again, buyer may qualify for seller financing. If they do not qualify for traditional bank financing, they may get a better rate. They may be able to convert it earlier, and buyer will not have to pay PMI. So once again, a big portion of a lot of payments, if you're paying less than 20% down, is mortgage insurance. And most of the time, there's no mortgage insurance on seller financing. So it's kind of a win for buyers. They might get a better rate. They have less cost to get the loan. And sometimes they're working with someone directly versus a big bank. So those are all pros of doing it for both sellers and buyers. Cons, though, to be aware of, seller doesn't get all the money at once. They can't go out and buy something else. It's just they're going to get it in installments. They're going to get a down payment and monthly payments, and they got to rely on the buyer to make payments. Seller may have to foreclose on the buyer if they're in default. Okay, that's a big deal. Buyer may miss a payment. Okay, well, then what do you do if you're relying on that monthly payment every month for your expenses and they're late? You got to have a contingency plan in place. There are costs associated with collection of the payment and accounting through that third-party escrow. Buyer may end up paying more for the property. Okay, and buyer may have to get permission to rent or sell the property because even though they are owning it, that there may have been a condition that paragraph B, the seller says, I want to give consent on what you do with it until you pay me off. Okay. So there's definitely some pros and cons. Okay. Same questions for the loan assumption. When's a loan assumption good option? Well, like now, when interest rates are through the roof and you have a lot of sellers that are sitting on a really good rate mortgage, they don't own it free and clear, so they can't do seller financing. But they can sell the property, make it attractive for a buyer to assume their loan and pay the difference. Okay, that's attractive. So what makes it good for the seller? Well, the seller, they get more buyers. They can sell, they're more attractive, right? Their same property, that their neighbors at 500 and they're at 500, but their 500 is a lot cheaper to buy because it's at 3% versus at 7%, makes it quicker to sell. Okay. Why is it good for a buyer? Well, we know that because they're getting they're paying less over time. Okay. What's the risk to a seller? Well, the risk really is, and I'll talk about that in a second, is they still may not absolve all of their liability, even by letting someone else assume their loan. If that buyer defaults, there's still a risk to the seller in the long run. It's minor, but it's still there. What's the risk to a buyer? Not much, really. As long as they can qualify for the assumption, you're good to go. So can any seller offer a loan assumption? No, only assumable loans, right? And it's got to make sense. Does the rate right? Is it a VA, FHA? Is it a type of loan that allows another buyer to assume it? Okay. And so why do you think a seller would want, what do you think they would want in order to do a loan? Well, of course, they got to qualify, right? That's the biggest thing. Credit, terms, and so forth. And of course, we don't do this either. This is all that third party. We agree upon the terms, and then the buyer goes and works with the seller's basically bank and saying, all right, I'm going to provide all this documentation to you to see if I qualify to assume this loan. All right. This is the form. So very similar to the other form. This Turk 41.3 loan assumption addendum starts off the exact same way. Credit. Well, what do we want the buyer to provide? Well, we want a credit document, credit report, verification of employment, salary. They're going to be supplying this to the seller's lender, but we're going to say this is typically what we want. And again, we want a third party probably to provide it to us or to the lender in this case. So they may go to the lender and apply for credit, and they pull the credit report and provide financials, or we have them go through My Smart Move or whatever it may be, the service we use, so that they're qualifying before we go too far. They're qualified to assume a loan. And of course, the exact same terminology that was in the seller financing says if they don't supply the documentation in time, in the 7 days or whatever they agreed to, right? Says the earnest money will be paid to the seller. So the seller, again, after 7 days, if the buyer hasn't delivered these credit documentation that we've agreed to, credit report, bank statements, whatever it may be, pay stubs, the seller can terminate and keep the earnest money. So in both cases, they're exact same. And of course, again, if it is delivered and the seller's bank denies the buyer within 7 days of that they can't assume the loan, then of course then the deal terminates and the buyer keeps earnest money. Those two paragraphs are exactly the same for both seller financing and loan assumption. So it's basically we're verifying, do you have the credit? And then the seller, or in this case, the seller's bank, has the right to deny it, but the buyer has committed to provide the documents within a certain time period. And if they don't, it's a pretty big penalty when it comes to losing earnest money. All right, this is where it gets different. In the seller financing, you have the note, and then you have the deed. Here you have, okay, we're going to assume this loan. So at closing, buyer will assume in writing the following existing notes and all the obligations imposed by the deeds of trust securing the notes assumed. And then it talks about the first note, the second note. Most likely it's just one note. Here's the total balance owed. Here's the interest rate on it. And then paragraph 2, if you had a second note. And then it goes on to pay if the unpaid principal of any assumed loan as of the closing date varies from the balance stated above, that says the cash payable at closing or sales price will be adjusted. So what it's saying is, here's what we think is owed on the property. We're assuming this note. If we get to closing and that number is bigger, we're going to either increase the price of the property to cover that note, or we're going to adjust the loan amount or the assumption amount to accommodate the different loan number. Okay. Then it goes on to say, if the total principal of all assumed loans varies in amount greater than, you can put this in there at closing, either party may terminate. So let's say you're assuming $450,000. Let's say it's you put in there $10,000 and it's $460,000. If that's the terminology, then either party can give notice of termination saying, all right, this is not what we agreed to. It allows an out for seller or buyer at that point in time. So interesting on that one too. And then it says earnest money will be refunded to the buyer in that event. Okay. The buyer can at that point in time assume or choose to pay the difference because they're trying to buy the property because the terms are just good. Then a loan assumption terms is just like your note on the seller financing. Now that you've agreed, this is the loan. This is the amount that we're going to assume from the seller, their loan. This is the amount in terms. Then we're going to go down here and it says buyer may terminate the contract and earnest money will be refunded to the buyer if note holder requires a fee for the assumption. You give amounts there, an increase in interest rate more than. So if they're at 3.5 or 2.99, and the lender goes, we'll let you assume it, but at 4.5, they may not want this anymore, right? It may not be beneficial. So it allows them to terminate if those terms change beyond that. And then any other modification. So if it's a 30-year loan or 25 years left at such and such price, if they change the terms of a loan, the buyer may go, no, that's not what I wanted. Paragraph E, remember we need to consent, possibly consent from the seller if the buyer did something with the property, if they chose option B in seller financing. Well, with assumption here is consent by note holder. If the note holder fails to consent to the assumption of a loan, either seller or buyer may terminate the contract by notice to the other party, and the earnest money will be refunded to the buyer. So the bank, if they fail to consent, basically they don't agree or approve the buyer to assume the loan, then either party can terminate and money goes back to the buyer. Paragraph F, unless seller is released from liability, here it is, on any assumed note, a vendor's lien and deed of trust to secure assumption will be required. The vendor's lien will automatically be released on delivery of an executed release by note holder. Is that right? We need to make sure that when your seller allows a buyer to assume their loan, that the buyer assumes all responsibility, that the seller isn't still liable. And then tax insurance, if note holder maintains an escrow account for the property taxes, home insurance premiums, mortgage insurance, and so forth, seller shall transfer the escrow account to the buyer without any deficiency. So basically, it's going to be paid and current. And then paid and current, and buyer shall reimburse seller for the amount and transferred again. So basically, whatever is due on the day of closing, it's prorated again, and it's now in the buyer's name, not the seller's name. And then the last one here says the lender, the authorization to release information. The lenders of note being assumed are authorized to furnish to the seller or buyer or the representative's agents relating to the status and consent of the consent to the consumption. So how well is the assumption going? Is loan approval done yet? Is the buyer going to be allowed to assume this loan? Then seller and buyer authorize the lenders of the note being assumed, title company, escrow agent to disclose and furnish a copy of the closing disclosure. Okay, typical stuff. Here's the provision at the end that the buyer and seller need to know. It says, notice to the buyer, if you're concerned about the possibility of future adjustments, monthly payments, interest rates, or other terms, do not sign the contract without examining the notes and the deed of trust that you're assuming. Seller, your liability to pay the notes assumed by the buyer will continue unless you obtain a release of liability from the note holders, the lender. So the existing lender that you've got a loan through as a seller, buyer's assuming it. They may approve the buyer to assume it, but you want to make sure that this lender removes any liability that you may have as a seller. Okay. So if you're concerned about future liability, you should use the TREC release of liability addendum. So it refers to a form to make sure that the buyer now releases the seller of any liability for that loan that they're assuming. And then lastly, this should have been on the seller financing as well, but it says any note to be assumed or the deed of trust securing the note may contain a provision commonly known as a due on sale clause, stating that the note holder may declare the note to be immediately due and payable upon conveyance of an interest in the property. If the note holder fails to consent to the sale and assumption of a loan, the note holder may have the right to declare the entire note to immediately be due and payable in full. So if the lender fails to denies the buyer the assumption, in here allows as well, if the seller isn't continuing to pay the note, the lender can turn around and say, I'm fine. It's all due now, pay it off now, because they're not assuming the loan. They want to be paid in full when the property is sold. That's basically what they're saying. You can't sell the property without paying off the lien. And the assumption allows them to sell the property and transfer the lien to a new buyer. They're saying if they deny the buyer, you've got to pay the whole lien off. So the pros of assumption, of course, is the buyer can get a lower rate. That's really the biggest thing. And it makes the seller's property more attractive. Think about that for a second, right? Especially in this market, it's a great way to market. And the cons, the buyer may not be approved because sometimes their restrictions are a little bit tougher for an assumption than it is for an actual approval. And the lender, you think about this, they get a new loan on that property at 7.5%. Why would they want to have someone assume it at 3.5% or 2%, right? There are some reasons why. Also, instead of the buyer and the seller, the two agents, escrow and title, you actually have the lender involved now, a second lender. So adding another layer of subject twos, right? It's always added more complexity. And the seller may be responsible still, even in the event of buyer default. So we want to make sure we deal with that up front, but that is a potential con when dealing with an assumption. And then, of course, there's questions. But so these two forms are very useful, especially in this market. But we want to make sure that all we're doing is having the buyer and seller agree to the terms, making sure they're aware of the risks, and then having them talk to an attorneys, financial professionals, and escrow and title to carry out what we agree to if it makes sense. I'm going to stop sharing here. We did pretty good today. If the seller has equity, does the buyer pay the equity in cash? Yes. So let's say that they're 2 years into their note and the property's gone up in value. They're paying $600 for it. They owe $500 on the loan. Buyer assumes the $500 and pays a difference of $100,000 in cash. Now, or they would buy a whole loan for it. But yeah, they would pay the difference. Now, that may be a downside for a buyer too. They want to assume this great loan at 3%, but they don't have enough to make up the difference, right? You know, this is one of those things where I'm not advising this, but when markets have turned in the past, this is where these two forms will work in conjunction. I'll assume the note is in first position. Okay, the 100,000, I'm going to have the seller finance as in second position behind the first note for a period of time. So you could actually use them in conjunction, where the seller is the bank only for that 100,000, right? And then the main bank is the lender for the whole amount. But you want to be very careful because that second position has no standing. You know, if they default on that, the first mortgage gets whatever's left. And if there's a balance left, the second will get it. So, but that has been done a lot, especially when markets are crazy like this. It's a way to get a deal done. And usually they're short term, they're interest only. Like I said, 12 months or 24 months before they're cashed out. But then the seller basically gets to, you know, move on. Their mortgage is paid off, and they're getting installments for a period of time. So there's a possibility. But generally, yeah, you're paying the difference in cash. Is that good?
Yeah.
Any more questions? All right. Hopefully that was helpful. But these are something we're going to start seeing more of. So I'm glad we got a chance to cover it today. So, all right. Well, happy Friday, everybody.
Thank you.
You're welcome. You're welcome.
Thank you.